the state agencies, the university system, and all local governments across the state. With over 25 years of experience and a CPA license, he has worked extensively with both financial and performance auditing standards. Welcome, Dan.
So the first thing we're going to start with are changes to the state audit requirement. This is going to look at Senate Bill 2180, which was a bill affecting our section of code and where we'll spend the most of our time this afternoon in looking at these various bills and how they affect you at your different levels. So the primary change affecting local governments was increasing the audit threshold from $750,000 to $2 million. Now, this increase is retroactive back to January of 2022. And the reason that this was done was to supersede that previous threshold. So if you recall further back in time, the threshold for many, many years has been at 300,000. Last session, we raised that to 750,000, which was to take effect starting in January of 22 for that calendar year, and now the 2 million. But we didn't want too many thresholds in there to be confusing to people. So the legislature, when they passed this, they actually made it retroactive back to January, which basically erases the 750 threshold as if it never happened. So now the net effect of this change of going from 300,000 to 2 million is that an additional 230 local governments will no longer be required to get an audit and instead can complete an annual financial report and receive a basic review at a much lower cost than what an audit would be. That increase from last session, when we went from the 300 to the 750, it was the right thing to do. It just didn't go far enough to provide real financial relief to those smaller governments that need it the most. Now, an audit may still be required for other entities for other reasons. An example of this would be like bonds or loans. Sometimes those lending institutions, the banks, the bonding companies, they may still require an audit regardless of what our threshold is. So that would supersede, if you will, our requirement if they require it. More commonly would be federal revenue or for federal expenditures. If you expend more than $750,000 of federal money in a year, the federal government requires you to get an annual single audit, and that's in lieu of any requirement we have. So that, again, that would supersede ours. Another thing I want to mention with this is that all pass-through revenues, including federal money, are no longer counted as revenue. Again, for purposes of the threshold is actually looking at all revenues received in excess of 2 million. And we are no longer counting pass-through monies as part of that amount to meet that threshold. And since the change of the audit threshold also incorporates an allowance to get delinquent reports caught up, you can think of it like this. If you have less than $2 million in revenue for any year and you have not had an audit report approved by our office, then you are eligible to instead receive an annual financial report review instead of having to pay for the cost of an audit. Now, one other requirement that does go with this, and if you are delinquent, is we can get you caught up by doing an extended review, which we'll discuss further in the presentation. If you have a specific circumstance that you're wondering about or wondering, do I qualify for this, or I'm behind, I'm not sure if this will work for me, please give our office a call. We'd love to talk with you about this. So speaking of delinquencies, if you're a smaller government that's behind in submitting your reports and you're unsure of what to do or how to do it, just submit your bank statements to us and we'll help get it figured out for you. Yes, there is an additional cost to that, but a few $100s more in the cost of a review might be worth not having to hassle with trying to figure out all the numbers and how they work yourself. As an overview, all financial reports that are submitted to our office, so these are the annual financial reports, if for those that are below the threshold, all of those receive a basic review. And again, further in the presentation, we'll discuss more what exactly is the basic review, what all goes into that. We'll look at that further. Now, from that basic review, it could extend into an extended review. We will also go over what would cause that, as well as what is an extended review and what does that entail. And this happens if there are certain risk factors, which again, we will identify what those are later in the presentation. So that's kind of a rough outline of where we're going over the next several moments of time. One last thing I'd mention, and we'll talk about this briefly at the end of this section on Senate Bill 2180, is that we do have a new annual financial report form that we rolled out in January of this year. We are still continuing to undergo updates with that that will roll out, and so that will constantly be changing. One thing I would like to mention here at this point is that please be sure that if in the past you've ever downloaded that form to your computer or to your hard drive and you use that to submit it, that you not do that. Instead, every time you're ready to submit the next year's annual financial report form, please go out and download it off of our website. And that way you can always be sure that you'll have the latest version out there, which again, a lot of the changes that we're making, while we still want to collect the information and the data, we're trying to make it as easy for you to fill out as possible. So you want to have that latest version of that annual financial report form to make it as easy as possible on you for filling that out and sending it back to our office. So let's start with the details of a basic review first. All reports, as I mentioned, start with a basic review. And this gives us limited assurance that your finances are in order. It's not a full audit, it just starts as review. We're trying to gain some level of assurance that the numbers that we see, that the numbers you're keeping on the books, that they're accurate and they're in the right place. So the primary items that we look at during a basic review include the following. First, the balance on your books should match the bank balance. As they say, cash is king. So the bank is the right answer. And that's something you can use yourself. That's what we do when we get them. That's the first thing we look at is do they balance? And if not, why not? That's something that you can do yourself before you even send it to us, because you have the bank statements, you know what the right answer is. Now, sometimes your books will be off and you have no idea why. That's fine. If you can't get it to balance, send it to us. We'll either figure out why it's off and get it to balance, or we'll make the necessary adjustment to get them into alignment with each other. So don't fret and waste time over that. Instead, just get it to us and we will take it from there. So because of that, because everything's based on that cash balance, this is therefore, you can think of it as a cash basis report. Okay, now cash basis means that it does not include any receivables or payables or any of those other kinds of things, or fixed asset or any of that, because those items do not affect cash. So therefore, they are not to be included in the report. And if you do, it will mess up the numbers. So be sure to stick with just the cash, which is basically what goes in and what goes out of your checking account. So basically all the activity that you see in your monthly bank statements, that's what goes on this annual financial report form. It's that in and out of your cash, those items affecting your cash balance. So another thing to mention with this is, because it's cash basis, another thing to remember is that cashing in an investment is not a source of revenue. Okay, and we see this as a common mistake that we see, because say you have a money market or a CD fund for $2,000, it matures, you decide you need the cash, you don't want to reinvest it. So all of a sudden you get this infusion of money, but that's not a source of revenue. It was already considered money to begin with. So to explain that a little better, let me first define what cash equivalents are. Okay, so cash equivalents are those investments that are readily convertible into cash. So that's with typically maturity periods of 90 days or less. So some examples of this, I just mentioned CDs and money market accounts. Those are considered cash equivalents. Other things might be short-term government bonds, marketable securities, commercial paper. Some of those things you guys probably don't deal with as often, but yet still, those are all considered cash equivalents, which means that for the statements you're sending in, we count it as cash. So when you convert it from one to the other, it has no effect on the annual financial report form that you submit to our office. So keep that in mind. Another thing I'd like to mention in this section here about the cash aspect is that separate funds do not require a separate bank account. Now, obviously, if you have an investment like a CD or a money market, that would be in a separate account. Savings are often in a separate account. But otherwise, your separate funds that you have, your general fund, special revenue funds, enterprise funds, we're going to talk more about those later as well. Those do not need to be in their own separate checking account. You can have all of that activity in just one account because it's tracked separately in the books. So then you know what portion of that balance is attributable to what fund. Okay, so don't complicate things for yourself. The more bank accounts you have, the more bank reconciliations you have to do, the more bank statements you have to worry about submitting to us, as well as keeping track of. Then you have to add them together, make sure that they all come up with the right number for the total for what's on your accounting system, whatever that is. It's best to just have, besides your savings and your investments, just one checking account. Now, I do understand that sometimes people will have other accounts, like, for example, if you're in a small town and there's 2 banks in town. I understand the fact that you may want to have some business at both banks supporting both of your local businesses. And that's fine. If you did have to have a separate account, if you're like a city, you can do that for your, say, your enterprise funds collectively, your water, sewer, garbage, that kind of stuff. But as much as possible, the fewer bank accounts, the better for you and for us when we review your stuff. The second primary item that we look at in the basic review is that we look to see that there are no negative fund balances. Now, there shouldn't be any negative fund balance unless there's a plan to fix them. So just so you understand correctly, fund balances can go negative, and they oftentimes do in certain areas. Let's look at a few of the most common examples of that. So your enterprise funds, that's your water, sewer, garbage, most common. So those kinds of funds can go negative if you have an extraordinary expense. If a main water line breaks, your water fund is probably going to go in the negative to fix it, because it's going to cost more than what you currently have sitting in there. And that's fine, because you may already have a plan in place where you are currently collecting on a monthly basis more from your water bills than what your normal ongoing operating costs are. And so that fund will replenish itself. And usually that's in fact why you charge more money for your water, sewer, and garbage than what it actually costs to cover the ongoing operating costs, or for those one-time type expenses that can come up, whether it's a repair or a breakdown, whether it's constructing something new, buying a vehicle, whatever the thing might be. That's oftentimes why you do charge more, so you have money built up, saved up, to cover those extraordinary costs that come along once in a while. But even so, you can still go negative, and that's fine if you have that plan to recover that fund balance. It can also be done through general fund transfers. Maybe you get a lot of extra tax-based money from oil and gas revenues or something like that. Then you can just do a transfer over and bring that fund balance right back up. And that's also a perfectly legitimate way to do that. Another example of fund balances that can go negative are your special revenue funds. So, and again, we'll talk about this later too, exactly what these funds are. But at the end of a project, these special revenue funds for which they were set up for, it could come down to where you just spent more to accomplish that than what it cost. And in that case, you would either move some money over if you're going to keep that fund going, transfer some money over from your general fund, or if you know that you have future revenues coming in to that fund for whatever that special purpose is, that's fine too, because you know that that fund will replenish itself. So, and then third area is capital project funds. Capital project funds, and again, we'll talk about this later in more detail, but basically they're for capital projects for building large acquisitions of property or equipment. And sometimes they cost more than just the money we thought they would. We set aside money for this to build this building. The bids came in higher than we thought, the building costs more, the fund goes negative. And that's fine because that either can get closed out to the general fund or into your debt service fund where you most likely will have to repay the loan or the bond that you took out to cover for the cost of the project. So that happens on occasion in that regards. We understand those, but just make sure that if your funds are negative, you have a reason. Now, if your general fund is negative, that's usually not good in any scenario. Again, you can, if you get, maybe you have a lot of water sales because you're in oil country area and they need water. So if that's the case, then know that have planned transfers that have been approved by your board or council to go over to, again, replenish that general fund. So it's not that it's negative in itself, it's just that it can become a negative. And it's certainly an area of concern that we look at if you don't have a plan or we can't see what that plan is to bring that balance back up to zero. So the third primary item that we look at in a basic review is that the funds should be used correctly. And that's in accordance with accounting standards. And most specifically, that comes out of GASB 54, which is what originally set up the fund structure and how funds are to be used on your basic financial statements. So in order to kind of get that across, we're basically going to walk through each of the different fund types and talk about what this fund is and how it should be used. Okay, so we'll start off with the general fund because unless it fits better in one of the remaining funds we talk about, everything goes in the general fund. Okay, that's kind of your catch-all, if you will. And so anything can go in there. It's just a matter that not necessarily everything should go in there if it better fits in one of the following funds that we'll talk about. So let's get into the next category of special revenue funds. So by definition, a special revenue fund is a revenue source that is either restricted or committed for a particular specified purpose. So let's backtrack there just a moment. So restricted means that it is set apart by some governing authority. And this would typically be, the two most common ones would be North Dakota Century Code or the federal government. So if either of those have restrict what monies can be used for that you receive, that by definition creates and restricts that money, which then becomes a special revenue fund. Now, the other part I mentioned is that it could be restricted or committed. Committed is similar to restricted, but it's just not as high of a level of authority. And that basically is your own board of governance, whatever that might be. It could be a board, a council, a commission, whatever that is. If they have passed and it is recorded in the minutes that they want to set aside a certain revenue source or just a certain amount of money every month into a special fund for a special purpose, that creates a special revenue fund because they have committed those monies or a portion of monies to be set aside for a particular purpose. That is a special revenue fund. Now, keep in mind, those can be undone by future boards, committees, commissions, councils, etc. But for at least that period of time in which that's in effect, those do in fact become committed and they are to be set aside and placed in a separate fund for that purpose. So some examples of that might be your highway improvement fund, your emergency fund, federal grant monies, forestry fund, a centennial fund, insurance reserve fund, sales tax. There's a lot of different revenue sources that you might put in a special revenue fund. Now, in that example of highway improvement fund, which most all counties, cities have, those are monies that are typically set aside or come from the state. And in North Dakota Century Code, it specifically says these monies have to be kept in a separate fund. In other words, a special revenue fund. So, and the reason they say that, the reason Century Code has that in there is because they want those monies to be used just for road projects. Okay, and so that's an example, as I mentioned earlier, of a restricted fund. The others would all have to be committed ones that you would have for particular reasons. One that is we often see as a special revenue fund is the sales tax. Now, I would caution you on this one because this could go either way. And we see this one done incorrectly more often than not. A sales tax, if the sales tax that you have was passed for a particular purpose, most additional sales taxes that you have had to have gone through some kind of vote process for the citizens. They voted this thing in for a particular purpose. Maybe it's to get money for your school or for park districts or things of that nature, okay, for specific purposes. Economic development is another popular one for sales tax. So if it was passed, if the issue that was put out to the people, the referendum or whatever that was put out for the people to vote on to have the sales tax, if it was passed and it was put out there that this will be for a set purpose, then you kind of created a special revenue fund. Therefore, it should be in a separate revenue fund. And the monies coming out of that should be spent on that particular thing, because that's what you told the citizens you were doing. So that would be an example. If, however, it's just a basic sales tax, you just have a base level of 4%, maybe there's a 1% extra for the city or whatever. If you just have a set sales tax, it's not specified for anything unless they've set it, unless your governing board, whatever that is, has set aside a particular purpose, just put that in the general fund. Because out of the general fund, you can transfer it to anything, to any other fund for any purpose you want. And we'll talk about transfers in a bit too. But it's just much easier that way because, again, you may be using that sales tax for a lot of special purposes. I get that. However, if it's in a special revenue fund, then you have to have somewhere down through, again, in the meeting minutes, you have to have a particular purpose it's going to be used for, and you're restricted to that. You can't just use it for whatever you want. If you're doing that, you might as well just put it back in the general fund. So that's just a cautionary tale I give you about the sales tax as a special revenue fund. Next, we'll look at capital projects funds. So the definition for a capital project fund is it's used for the acquisition, the construction, or improvement of a major capital asset. So think of a major capital asset typically is a long-term asset, which means long-term means anything more than a year. So if it takes more than a year to build something, to buy something, or to save up for it or whatever, the major improvement, a lot of times these have to do with infrastructure, with land, with buildings, could be large equipment purchases, those types of things. That's best served with a capital project fund. One of the things too, even if it's something that you can just buy at a time, let's say you want to buy a major dump truck, for example. It doesn't take a year to buy a dump truck. It's just a matter of having the money. However, you may want to run that through a capital project fund because it may take you several years to save up for that purchase. All right. And there are, as was explained in one of the earlier presentations, when Alex talked about budgets, for your general fund and some of those other funds, you have to follow these rules to make sure that you're not overtaxing your citizens. One of the things that you can do in there is put some of that money into a capital project fund because you don't have to do a budget for a capital project fund. There's not a requirement for that in Century Code. Therefore, if you know that you're saving money for those large capital projects, you might want to set up a capital project fund so you can move that money in there each year until you've collected enough money to make that purchase, and then you can make the purchase. So that would be another reason that you would use a capital project fund, is to store up money for a project. Same with and it's not just for cities, this could be a park district. If you're a small park district, and you want to buy some new playground equipment, that might take you 5-6 years worth of your budget to save up enough money for a playground. So you might want to set aside some each year. That's how you would do that, is set it aside in a capital project fund so that you're not re-taxing your citizens to try and raise money for something that you've already started to accumulate. So that's what your capital project funds are used for. So the next group we'll look at are your debt service funds. Now you can think of this as a cash reserve fund that is used to pay the principal and interest on certain types of debt. And those are primarily your bonds and your loans. Oftentimes, the capital projects that we just talked about, in order to get the money to do those, you had to take out a loan or a bond. And because you just don't have that much cash hanging around. And if that's the case and you do, oftentimes the banks will require you to set up a separate debt service fund because they want to make sure that you have a way to make your annual payments on that debt. But regardless of that, accounting standards require that you run that through a debt service fund if it takes longer than a year to pay back regardless. So that's basically, and think of the debt service as kind of an in and an out. You know, you are transferring into that from whatever dedicated source you determine you are going to do to be able to pay back this loan or bond. You're going to deposit that revenue into that account, and then on an annual basis, when you make that loan payment or that bond payment with principal and interest and whatnot, then you just take it out of that and pay toward that. So typically your debt service fund balance hovers around zero, depending on if hopefully whatever comes in is at least enough to pay it off. Sometimes it's not, and that's fine. You can transfer general fund money in there to make up the difference so you can make that payment. That's perfectly fine, because as we'll talk about later, the general fund can transfer it to anywhere. So, but that's primarily what your debt service fund is it's a way to set aside revenue so that you can make sure you have enough to pay the payment at the end of the year. Because the people you borrowed the money from, they want to make sure that you can make that payment. And you also want to be in the position to be able to make sure you can make that payment as well. So that's what that debt service fund is used for. Next, we'll look at the enterprise funds. Now, by definition, enterprise funds are self-supporting fund that sells goods or services to the public for a fee. Now, when I say self-supporting, don't take that to the extreme to mean that it has to cover all of its costs, because that's not always going to be the case, and that's not always practical. Sometimes the cost of providing a service is just higher than what you think the citizens are willing to pay for it, but yet you still want to provide the service. So it's okay to supplement that with transfers from some other fund, such as a general fund or such. So it should, though, the point is that it should primarily cover the cost of it, or that's the intention of charging the fee, is that you are trying to recover the majority of the cost of providing whatever that good or service is. Now, as some examples, again, the usual suspects that I already mentioned, your water, sewer, garbage, those are your typical ones. Some other ones that we've seen a store, a cafe, a campground, an RV park. It might be certain other types of activities can be in there as well. So those are often ones that are also in there. Ones that we don't see as much of are trust agency funds. So the definition of that is a trust. They're similar. So a trust holds property or assets on behalf of another. Another meaning another non-government entity. So it'd be like an individual or some other institution. An agency, on the other hand, holds property or assets on behalf of another government. Okay, so when we look at the examples, and I'll throw out a few, park, a library, museum, airports, JDAs, all those kinds of things. Those are separate legal entities. They're not component units necessarily, but a lot of times you receive the money that then has to be dispersed out to them, because a lot of the money, the revenue that you get from the county or from the state, if it's coming from the state tax department or state treasurer's office, it gets sent to the city, it gets sent to the county, and then it's meant to be, a portion of that is meant to be sent out to other smaller districts, like your park districts and water districts and things of various natures like that. So your libraries and museums and whatnot, a lot of times money gets sent out that way. So that's, and then the trust, so those are all agency funds because those are other government entities. The trust would be money that's held for something else that would be more along the lines of if you provide your own pension plan and things like that. And that money or money you're withholding from people's paychecks. It's not your money, and it doesn't belong to another government. It belongs to that employee, but it's being held as part of a trust or pension plan or something of that nature. So that's where that falls in. So the fourth and final primary area that we look at in the basic review has to do with transfers. Now, transfers should be proper. Basic accounting principle is that debits equal credits, which, as it relates to transfers, means that what goes out of one fund must go into another fund in the same amount. Okay, that's what keeps them balanced. And so it's not just that they need to balance in that regard. Transfers also need to be allowable. And for different fund types, that can look different. So again, let's walk through the different fund types and talk about what types of transfers can be done. So let's start with the general fund. As we said at the beginning, anything can go into or out of the general fund. Same thing with transfers. So you can transfer out any amount of funds to any other fund. It's that simple. That's why, back to my example with the sales tax revenue, usually even if you're earmarking the sales tax receipts for a lot of different purposes and stuff, and it kind of seems like it could be a special revenue fund, it's usually best just to keep that in your general fund because you can transfer that money out wherever you want, in whatever amounts you want. And then you don't have to worry about that. So special revenue funds. Now, as we mentioned, special revenue funds are money set aside for a specific purpose. Therefore, that money is not meant to be transferred to any other fund because it's set aside for a specific purpose, which means it should only be spent on that purpose, whatever it was that was restricted or committed, remember. So whatever that purpose is, that's what the money should be spent on. It shouldn't be transferred anywhere. There really should not be transfers out of your special revenue funds. The caveat to that would be, of course, if you are closing out the fund. If the fund has served its purpose, if it was set aside for, let's say, a centennial celebration. Well, once the centennial celebration is over, if you still had some money remaining, then you would just transfer that back to the general fund, and that closes out the fund because it served its purpose. It's no longer needed. Okay, so that would be the only real time that you would do a transfer out of the special revenue fund is for that purpose. Capital project funds. Again, it's money set aside for the capital project. So it's meant to be spent on whatever it is that major improvement or that construction or that major purchase that we talked about earlier. That's what the money's meant for. It's not meant to go anywhere else. So again, there really should not be any transfers out of the capital project fund. So now, of course, the differences for this would be if, let's say you had set that aside, maybe you didn't have to take out a loan or a bond or anything for this major capital project. You were just setting aside general fund money every year into it. You got enough, you had enough, you bought your big dump truck or whatever, you had some left over. Well, the fund is you're now done with the fund. So that excess money that's in there, you would just transfer back to the general fund. More than likely, that's where the money came from to begin with. So now, on the other hand, though, if you had financing to make that capital project purchase or remodel or what have you, then you still have to pay back whatever it is that you took that money out for. And remember, we talked about setting up the debt service fund. So that's an example of where then if you have extra money left over, really it should be transferred into the debt service fund to help pay back that loan. All right, so then let's look at the debt service fund. The debt service fund you would transfer out only to the general fund, and that's when you're done with it. When you finish paying back whatever it is you need to pay back, then you would transfer to close that out. And then enterprise funds. So enterprise funds are a little bit different in the way they operate. So think of an enterprise fund this way. You can have capital projects that are run through your capital project fund that are actually related to your enterprise funds. Say you're building more water lines or building a new sewer lift station or whatever. There's all these kinds of big projects that can happen. If that's the case, and you are wanting to transfer money to the capital project fund to pay for that, or to the debt service fund to help pay for the loan that you took out, again, for that water sewer type project, that's perfectly fine. And you can do that in whatever amounts you want, providing there's money in the fund to transfer, of course. Now, otherwise, you can transfer out of your enterprise fund. If you have excess funds, you can transfer out like to the general fund to use it for other purposes. However, if you do that, North Dakota Century Code does limit you to 20% of whatever your current year revenues are for that particular enterprise funds. So keep that in mind. So for example, if you have $1,000 in revenue in your water fund and you want to transfer excess into your general fund, you're limited to 20% of that year's revenue, which would be of $1,000, that'd be $200. It doesn't matter how much you have in the fund. You could have $2 million in the fund. You're limited to whatever your revenue was for that year. That's all you can transfer out in accordance with North Dakota Century Code. And the reason they do that is to keep people from too much overcharging the citizens for those services. So, and then of course, trust agency fund, that one's pretty simple. The money's not yours. You can't transfer out of that. So now let's look at risk assessment criteria. So this pretty much covers those 4 areas we looked at, pretty much cover the basic review. So what then would cause the need for an extended review? So the following criteria has been established to trigger an automatic extended review. The first of these is if you have revenue between $300,000, and remember I said at the beginning, that was the old threshold for having to get an audit, and now the new threshold of $2 million. So now, if you fall in that range there, you are one of those government entities that at some point in the past, you used to have to get an audit, but now you no longer do, okay? And as I mentioned, that has affected many hundreds of you. The thing is that those coming off that past audit requirement must receive at least one extended review. The reason for that is this was a crucial piece of our testimony to the legislature in order to get them to increase that threshold to the 2 million level that it's currently at. We said that we could still provide the transparency that an audit does without having to force you guys to get an audit. And that was, again, that was a crucial piece of our testimony because that was a concern that was there is, well, if you don't have the audit, then there's no transparency. How do we know the monies are being spent correctly? So forth and so on. This is how we convinced them of that, is that we said we would do an extended review. And that would be, and again, we'll talk about this in the future here, but a spoiler alert, it's kind of a mini audit, but yet not at the cost of an audit. So again, we'll get into that, but that was part of what we had said is that we do that. Now, if the extended review, if it reveals no problems or issues, you might not need another one for many, many, many years. Okay, so it's just to make sure that what's happening or what's going on is still the way it's supposed to be, even though you're no longer being audited. It's that make sure that the books are still in order, that the numbers are still tying out, and everything looks above board. So that's one of the things that will trigger an automatic extended review. Another one are one-time revenue increases. Now, we've already had a lot of these in the past, and these are the things that cause your total revenue to temporarily exceed that audit threshold. You may not normally be above, say, the 300,000. Let's go back in time for a bit here. This happened to many entities out there that we are now doing extended reviews on. maybe you normally only get $200,000 a year in revenue, but then all of a sudden you got a federal grant to put up a new playground, or maybe you took out a loan so you could buy a fire truck. Okay, those are examples of where that one-time source of revenue would have put you above that $300,000 threshold and required you to get an audit at that time. But the money, if you think about that, though, the money you received for that pretty much all went towards whatever it was you got the money for. You don't have leftover money to pay for the cost of an audit. So now you're normally a $200,000 local government. You spend about $180,000 of a year, and you have to pay for a $15,000 to $20,000 audit. You can see that doesn't work very well. So one of the things that we got put into this legislation that passed was the ability to go back in time to those one-time funding increases that went over, and to be able to say, hey, we can do this as an extended review. Just look at those areas of risk, which would be why you got the extra money, make sure that they were spent fine, and be done. And then that way you don't even have to pay for the audit. Now, not in the same manner that happened in the past, that can happen in the future as well. So going forward, again, even though we moved that line, it's now $2 million, it's still a line in the sand. So at any point in time, if you're close to that line and you get a one-time funding increase, you know, if you're an ambulance district and you're operating at about 1.9 million and you get a bunch of donations, now you have to pay for an audit. See, so we still have that ability to say for those one-time funding increases, we'll just do an extended review instead, and you no longer have to get an audit. And because we recognize the issue that this causes, and we feel bad for the people that got caught in that situation and have already had to pay for audits, but we recognize that. We did what we could to fix that in this session so that going forward, that doesn't happen again, okay? So these one-time revenues are not your typical revenues sources or operating. It's not your normal operating revenue. So these can include, for example, if you took out a bond or if you took out a loan, if you got a grant, a federal grant or state grant. Now, let me put a caveat to that, though. That's if receiving grants is not part of your normal operating revenue. There is an example, for example, libraries. Libraries always get a grant from the state library every year. That's just part of your ongoing revenue. That's not a one-time revenue because you get it every year. One time means it just doesn't happen all the time, or you don't know it's going to happen. It's not pre-planned necessarily. Donations is another one. There could potentially be others as well. Those are just the most common kind. The third one criteria that would trigger an automatic extended review is severe delinquency. So severe delinquency could be defined as anything greater than 2 years delinquent. So the way we consider something delinquent is based on a year's time frame. So for example, if you are in a calendar year, so we are right now in 2023, that means the calendar year 2022, which ended back in December 31st, okay, you basically have this entire calendar year to get your entity audited or to submit an annual financial report. So you're not considered delinquent for this entire year. Once it gets to December 31st of this year, anything 2022 that we haven't received, that's now considered delinquent, 1 year delinquent. So you can see that by the time you get to several years out, that becomes severely delinquent. That becomes a concern. And part of that concern is when we do our reviews, whether it's you getting an audit or you submitting an annual financial report to us, wherever you fall on that line of the threshold, that review process, that audit process, that's what makes sure that the numbers are right and that you are doing things correctly so that the numbers stay right. If multiple years go by and you aren't doing things correctly and we don't have the opportunity to course correct, then that just further exacerbates the problem, see? And so that's why severe delinquency becomes a great concern, because too many years go by and a problem that starts off small can suddenly grow very large, and it becomes much more difficult to fix. Okay, so that's how that works. So that takes care of the ones that need it for extended review that's required. So now for the ones that are can come about for other reasons. So I said everything starts with a basic review. So the following criteria has been established to trigger an extended review, which may happen during the basic review. So that's if transfers are excessive or they don't balance, because that's indicative of a potential problem of how and when those transfers really should be utilized. So basically, think of it this way: transfers should be done annually. Now, I understand that you might want to do them quarterly, just because you want to close out a fund, or because you want to not have a fund balance be left negative. I get that. That makes sense, and that's fine. But monthly, that's excessive. Okay, so that's one of the things that we look for. Suspicious looking expenditures. That's where something just is out of the ordinary for that type of government. It just doesn't look right to us. It doesn't necessarily mean that it's wrong, but it does warrant further review. So that could also be if expenditures are too much or piled into like a miscellaneous expenditure category, and we can't tell what's there. That's a good way to just kind of bury numbers, and we don't like to see that. So that could trigger an extended review. And then the third one is if fund types are used incorrectly. We just went through what the different fund types should be used for. So if we see that you're not using them for that, well, that triggers a reason to look further into what's actually happening. A few more additional criteria that could trigger an extended review during the basic review. If we don't receive data up front, if we notice, we ask for everything up front. If we notice that a bank account's missing because things aren't tying out, oh yeah, we forgot about this other account. Well, now that makes us wonder, well, what else was forgotten? What else didn't get to us? So we may look further for that reason. And then finally, material adjustments. Well, we almost always have to make adjustments because the numbers don't always tie out, and that's fine. That's not a big deal. But if it's a material adjustment, if it's a significant amount, that's a little concerning, because then it could be that there are many incorrect or unrecorded transactions at play that that would warrant being looked at. So sometimes it's known up front if an extended review needs to be done, as I mentioned with the first ones, the threshold change, the one-time funding, severe delinquencies, and sometimes, like the ones I just went through, we don't know until we actually do the basic review, and then that itself triggers an extended review. So now we've discussed the prime areas of a basic review and seen some of the risk factors that can lead to an extended review. What is an extended review? So as I mentioned earlier, an extended review is like a mini audit. So basically, we look at several different things in here. We can look at the revenues. Revenues are making sure that you receive the money, you got the correct amounts deposited into the right funds. Those are the kind of things that we look at. Also, we look at, are there restrictions on those funds? Can they only be spent on certain purposes? So that's where we'll look at with the revenues. We look at expenditures. We may look for unusual vendors. We may look for expenditures that aren't classified, things of that nature. Construction cost. If you have large construction costs, if it's over $200,000, we might look to see, did they follow proper bidding requirements? Payroll. Are those 941s filed properly and timely? The IRS does not take very kindly to not receiving their money on time. Transfers. We just talked about transfers. Are they proper? Are they approved? Are they correct? The right funds? All that sort of thing. And fund balances. Negative fund balances can trigger it. Again, we talked about that. And then one of the things, the last one is budget tests. We will look at budget tests for those that are required to do a budget in accordance with North Dakota Century Code. These would be your cities and your park districts. Okay, that would also include your counties too, by the way, but there are no counties that get a small review. All counties are required to get an audit because all counties receive more than $2 million in revenue. So now not all of these areas are tested in extended review. It's just based on what was the area of risk. and we just test those areas and that's it. Now, while an extended review can cost a bit more than a basic review, it can be upwards of a few $1,000s, in fact. The difference is that is in lieu of, and remember this, that is in lieu of having to get an audit, which can cost tens of thousands of dollars. So that's what you have to keep in mind if you get an extended review. It's not in lieu of a basic review. That's already happened. It's in lieu of having to get an audit. And that's what this whole change with this bill was all about. And then, as I mentioned at the beginning, we do have a new annual financial report form that we have. It's under construction. We're going to continue to make updates with it as we go. So going from there, so let's transition into, we'll quickly look at the end here in the last few moments that we have at a few other bills that will have some impact on you as well, depending on whether you're a city, county, or just any local government. So first up is Senate Bill 2162, the oil and gas production tax allocation. All right, so as you guys are aware, there was a combined 10 mil requirement for the County Road and Bridge Fund, the Farm to Market Fund, the Federal Aid Road Fund, and the County Road Purposes Fund. So for those 4 funds, most people of which just have the County Road and Bridge Fund, but regardless, if you did not levy a tax of at least 10 mils for that fund, then you were not able to get the oil and gas tax monies, production tax monies. That requirement has now been eliminated. And that was taken out, that wording was eliminated in North Dakota Century Code 57-51-15. So previously, you couldn't get that oil and gas production tax money unless you levied that 10 mil minimum, even if you didn't need it. But using our budget form also caused issues because our budget form said that you shouldn't tax a certain amount of mill levies, but yet you had to get the money. So it was in conflict with the budget form that we put together. This change now gives counties the autonomy to decide whether they need to levy additional taxes for those road projects. This will help prevent your citizens from being overtaxed in one area just to receive funding in another. Next one I want to talk about briefly is the Infrastructure Revolving Loan Fund, which is House Bill 1292. So what's changed here is that recreation and community facilities have been added to the list of eligible facilities for this infrastructure loan program. Okay, so just a quick background on this loan program. Bank of North Dakota gives out money to construct new or replace existing or new, what they call essential infrastructure. Okay, this excludes routine maintenance and repairs. Okay, this is just for the construction or the replacement of. So essential infrastructure is actually defined in North Dakota Century Code. It's defined as the water and sewer lines with the lift stations and the pumping stations. It's the stormwater infrastructure, including curb and gutters. It could be the paved and unpaved roads and bridges leading to it. And it can be other things such as your natural gas transmission infrastructure, your communications infrastructure. So think of it this way: if you build a building, a maintenance shop, and you have to have road access to it, you have to run gas lines to it, water lines to it, electricity line, the cost of those is eligible for this loan program. That now includes recreational facilities. Okay, so that's all that this bill does, is adding that example in there. I don't know if the legislature allocated money for this loan program. I know they'd used up most of what they had as of the last session. They may have added some more. I don't know what that is. You'd have to contact the Bank of North Dakota, but just be aware that that is now out there. So next is the bid for highway improvements, House Bill 1127. So what's changed here is that what used to be the $100,000 level for a bid requirement has now been increased to $200,000. So that's for any of those and again, this is for counties, but for the highway improvement projects that have been raised, it's been raised from $100,000 to $200,000 before you have to put it out for bids. Now, At the same time, they did suspend that requirement, that they suspended the bidding requirement if it's because of a natural disaster or some other kind of casualty that would cause public harm if there's a delay in the process. Think primarily access. If people don't have access to town or to their homestead, that becomes an emergency to get that road fixed. You don't want to have to wait for bidding requirements for that. So now likewise, they also, in that same bill, did the same thing with bridges. So the bidding requirement for rebuilding or repairing bridges was raised from what used to be 30,000, also up to that 200,000. Okay, and so, however, what they did in there though is they did add an additional bidding requirement before that. So for anything from 50,000 to 200,000, they want you to try and get at least a minimum of 2 quotes from contractors if possible, just to show you're putting out some effort for those projects. But again, on both of those, the bidding requirement has been raised. Next one to mention briefly is cooperative purchasing agreements. So Senate Bill 2370, this is a bill for both counties and cities. So a county can now participate in a cooperative purchasing agreement with the state, another political subdivision of the state, or in fact, even another state. And that's by setting up a joint powers agreement. And the caveat to this is that it would require the approval of the Board of County Commissioners. The exact same thing was done for cities. Again, you can cooperate in these cooperative purchasing agreements with the state, another political subdivision of the state, or another state entirely. Again, it has to be at the approval of the city council. One thing to note on these is that you have to weigh the benefit of the savings from participating in this with the loss of not supporting your local business. So keep that in mind when you do this, because your local business may not have had the opportunity to participate in this cooperative purchasing agreement, and therefore they're cut out of being able to get that business from you. So something to keep in mind. There is no slide for House Bill 1245, which was the last one I'll just mention real briefly. I actually just spoke about this at extent at the recent North Dakota Association of County meetings that happened last week. And this is a bill for the counties, and it's about reporting fund balances. And annually by March 1st, the county auditor must submit a report to our office of your ending fund balances for your general fund and your county road and bridge fund with a breakdown of any of that amount that is committed for a specific use. So just making you aware of that. And that was a change to the taxing section of code, North Dakota Century Code 57-15-30.2. And again, on any of these things, if you have questions, please don't hesitate to call our office. Thank you.
All right, thank you, Dan. We do have a lot of wonderful questions from Dan's session, but we are just going to take a brief pause here and move those questions over with the Q&A panel, which will just take a couple minutes here to set up, and we'll be right back.